Hi, this is Fritz Meyer. I just wanted to respond to some of the questions we got yesterday on the monthly webinar. The first question that came from Andy Gluck was regarding your comments about HELOCs coming back. Martin Wolf, the chief economic correspondent at Financial Times, says he's worried the U.S. might make the same mistakes all over again and get too loose with credit. Does that sound possible to you? Well, should that happen, I think it's way off in the future for a number of reasons. First of all, I think bankers generally learned a very important lesson. And secondly, I think probably Dodd-Frank includes a lot of provisions that may make that more difficult. But nonetheless, as every economic expands and progresses year after year after year, complacency sets in, and so sure, at some point in the future, we could be back to that kind of reckless behavior, but I just don't see it happening anytime soon. And at the same time, I'm really gratified to see the data in this chart, for example, that shows that bank credit is finally starting to expand at a healthy clip, 7% year over year most recently. Remember, bank credit needs to expand at the economy's nominal rate of growth just to avoid deflation. So if the economy today is growing at 4.5–5% nominal rate of growth, the 7% growth in bank credit is not far outstripping the nominal rate of GDP growth. So even at a healthy 7% rate of growth, I'm not concerned that inflation comes roaring back anytime soon because the money supply is surging. That's clearly not in the statistics, at least yet. The second question, again from Andy Gluck, and this was in the context of my talking about the shale drilling revolution and what that's meant to the United States economy in a very positive way. He asked, Keystone Pipeline seems likely to get okayed now with the Republican election victory over the objections of environmentalists. Any idea how that affects crude prices? As a matter of fact, I don't think Keystone probably will, should the pipeline actually get built, which, by the way, will take years. But I don't think it'll have any effect directly on crude oil prices. And the reason I say this is because what's happened is that the producers in the Bakken, for example, in the Wilson Basin in North Dakota, have already circumvented what will be the Keystone Pipeline route, which is to say they're using rail transportation already to get the oil to the Gulf Coast and elsewhere, refineries all around the country, but particularly with respect to Keystone, it's getting the North Dakota crude down to the Gulf Coast refineries. And that's already taking place, having substituted rail car transportation for what will be pipeline. And the only difference will be that it'll be cheaper to transport that oil, and actually with a lower carbon footprint with the pipeline than with rail cars. Third question, at what point do you think the U.S. starts to pay more attention to environmentalists and anti-carbon fuels? It reminds me of 1994. I'm quoting Andy Gluck here. When Marty Whitman, one of the world's greatest deep value investors, told me that people will no longer be allowed to smoke in public places. This was a decade before cities began passing such law and was unheard of at that time. I see the environmentalist argument as one we as a society must inevitably confront. And as when we as a society started to discourage smoking, we will one day decide the environmentalists are right and this is bad for the collective well-being of Americans. One day a switch goes off and American society will say it no longer can tolerate fueling society by burning carbons. I'm saying I don't know when that switch will go off, but I'm sure you do. No, I don't know when that switch goes off, but let me give you some statistics that I think are relevant to the environmentalist argument. First of all, with respect to CO2 emissions, this is pretty interesting data. In the period 2007 to 2013, the U.S. has actually moved to significantly cutting its CO2 emissions. We're emitting 10% fewer tons of CO2 today and through the end of last year, 2013, than we were in 2007. And likewise for Europe, the comparable statistic for Europe is 7% less. So the United States has already meaningfully cut its contribution to global CO2 emissions. And in the meantime, China has increased its contribution to global CO2 emissions by 40%, 40%. And India has increased its contribution to global CO2 emissions by 26%. So that today, the United States is emitting 60% of what China emits. In other words, 40% less than what China emits, and the rate of China's growth in CO2 emissions is 40% compared to minus 10% for the United States. And the reason I cite these statistics is that I think Americans, broadly speaking, will probably continue to conclude that, wait a minute, we've already made strides, and particularly with shale drilling, we have actually substituted a lower CO2 emitting fuel, natural gas, for a higher CO2 emitting fuel, coal. So we have already improved our carbon footprint significantly, and considering that China and India combined account for the vast majority of global CO2 emissions today, and they account for most of the growth in global CO2 emissions, why should we Americans take steps that might severely restrict our economic growth when probably those steps wouldn't make a whole heck of a lot of difference from a global standpoint anyway? I'm voicing an argument that I think increasingly Americans have come to embrace, actually. And so I certainly don't know when the switch goes off. In other words, when Americans finally decide, oh, we really need to take drastic action in this regard. And my own view is I'm not sure that we ever hit that point, but certainly not within the next decade or the following decade after that. So I think probably with respect to shale drilling, we're going to continue to see the expansion of that here in the United States, because I think it's viewed in many respects as actually improving our CO2 footprint as compared to where we were burning coal. And I think also Americans have concluded that a broad-based switch to solar, or an attempt to substantially substitute solar and wind or other renewable sources, is really unfeasible given current technologies, and we'd have to make enormous strides in further developing those technologies such that they're cost effective before most Americans would be prepared to say, well, let's do it. The next comment here was on this slide number 43 with respect to the initial Fed funds rate hike cut. I just wanted to reiterate then the point I was making in that slide, because at this juncture this is crucial, and so I'll take this opportunity to just repeat what I said yesterday because I think it's so important. I don't know why stock market investors or talking heads on CNBC, for that matter, or other voices in the media should be at all concerned about the timing of the first Fed funds target rate hike, as if that event could somehow impinge on the economy and secondarily the stock market. And the reason for that is, historically, what you see in this chart is that there is an extremely long gap between the initial target rate hike and the ultimate peak in these stock market rallies. And specifically, here the first target rate cut was in 1993, and the market didn't peak for 7 years to 2000. And similarly, the first Fed funds target rate hike occurred in 2004, and the stock market didn't peak ultimately until 2008. So 4 and 5 years has been the lead time. And the reason for this is because it takes a long time, and a lot of economic momentum gathers during a period of economic expansion. It takes a long time for the Fed finally to decide it wants to flatten or invert the yield curve in an effort to damp down economic expansion because they're getting worried about inflation. And so we're so far away from that point that I said yesterday, I don't know why anybody gets their undies in a bundle over this. And in fact, what we've seen is, yeah, maybe the first target rate hike has created a stutter in the stock market. And you actually have seen that in actually all three instances illustrated in this chart. But thereafter, the stock market has gone on to race higher as the economic expansion continues to unfold. And it isn't until years later that finally the Federal Reserve gets to the point with the short-term interest rates such that they manage to invert the yield curve, as you see in this previous slide, where finally, when the yield curve finally gets inverted, which is to say short-term interest rates finally were pushed high enough to equal or exceed long-term interest rates, and you finally managed to choke off economic recovery, that then has resulted in a bear market in stocks. But my point yesterday, which I feel is so important to understand, is that it could be 4 or 5 years from the timing on the first short-term interest rate hike. we're on slide number 53, and the comment was that I sounded worried about this problem with European economic growth and bond yields staying low. Are you at all worried about deflation? Well, I'm not worried about deflation in the United States, but maybe what you're suggesting is we should be worried about deflation in Europe. Well, at the beginning of yesterday's presentation, I went through the most recent economic data from Europe because, as you may recall, last month the stock market hit an air pocket, a very significant 10% correction, in large part in response to the IMF's most recently cutting its forecast for European economic growth. But yesterday I was making the point that while the IMF shaved their estimates for Europe's economic growth both this year and next year, the trim was only a modest 20 or 30 basis points country by country in Europe. And furthermore, the IMF still believes that we're going to see better economic growth in 2015 than in 2014. In other words, Europe still, in the minds of most economists, should be accelerating, even though the growth is very mediocre. Less than 1% this year, a little bit more than 1% next year. And I also pointed out yesterday that Europe's index of leading economic indicators has flattened. It's not declining anymore, and the Purchasing Managers Index is also flattened or ticked a little bit higher this month compared to last month. So all of which suggests to me that while Europe is fairly stagnant, close to no growth, economists still believe that we'll have some growth this year and a little bit better growth next year. And that, to me, is a situation that is clearly tolerable. And as a matter of fact, I don't know why anybody would expect any growth from Europe, because they have a contracting population and they simply can't get productivity gains, the two independent drivers of economic expansion. So in my mind, as long as Europe doesn't go into some renewed recession, I don't think it really will have much impact at all on the forecasted outlook for U.S. economic growth. And as I pointed out today, our economic forecast here in the United States is increasingly looking better all the time. We're gaining economic momentum, and I don't see Europe impacting that. So I don't see Europe as being a problem for the U.S. economic outlook. I do think that the bond yields that you're looking at in this chart are probably going, well, put it this way, Germany's bond yields and Spain's bond yields probably, if anything, continue to trend lower or perhaps stabilize. But if Germany's Bund yield stabilizes sub 1%, then I think you're going to see continued downward pressure on the U.S. Treasury bond yield. And that was the point of this slide, to try to explain why U.S. Treasury yields really don't make sense from a fundamental standpoint. In other words, 1% real yield on the U.S. Treasury is not very attractive, and you have to wonder why any American would buy a U.S. Treasury bond at a 1% yield. The answer is, well, fundamentals have been trumped by the global supply and demand for bonds, a dynamic, and I don't see that changing anytime soon. So probably U.S. bond yields stay low for long, which clearly has been a huge surprise to most forecasters. Here we're on slide number 71, and the point that I made yesterday with respect to this slide is that aggregate employee compensation has been in this consistent rising pattern, and most recently is up 4.8% year over year. Now that is a different number than the median and mean income statistics that we've become familiar with, which is to say you're looking at an aggregate here. It is not per capita. And the distinction there, I think, is pretty important, because a lot of people have been now told by a lot of commentators that this recovery has really been bad for and very weak, and so that with median and mean income having gone flat to down, actually both of those have turned up just marginally recently, but on a per capita basis, Americans are behind the eight ball. We're actually earning less per capita in real terms than we were several years ago. And the normal reaction to that is, well, how can we be having decent GDP growth and decent earnings growth if consumer income and spending are what drive the U.S. economy, and both have been stagnant? And the answer then is you have to go to this aggregate statistic. Total employee compensation is what we're looking at here. Now, the drivers of total employee compensation are the three that I've indicated here. Rising employment, in other words, we created a net additional 214,000 net new jobs in the month of October, and employees have been earning a little bit more per hour. It's been modest, but wage gains have been steady, and Americans have on average been working longer hours. And so those three combined to drive this aggregate employee compensation statistic, and most recently that was up 4.8% year over year. And I think that's a very important consideration because, again, I think the general perception is, based on the median per capita statistic, that income growth hasn't been adequate to drive healthy growth in the economy, consumer spending, and corporate earnings. And that situation has been a lot more favorable than generally expected. It reflects the concentration of wealth growing. In other words, to the extent that median and mean incomes haven't been growing, but the aggregate has been growing, it reflects a concentration of wealth. And what I'd like to do is to take you through a series of slides that I've included in the full version of my monthly PowerPoint presentation, but I thought I'd just take this opportunity to present a fairly broad array of data that relate to both income inequality and the distribution of income and taxes in the U.S. economy, because it's an important topic because, as we all understand, this president in particular has made income inequality an issue and has tried to adopt a number of measures that will address income inequality. So without taking sides in that discussion, I just thought I'd present the data in what I hope is a real understandable form so that at least we're all on the same page with respect to what actually has been happening. In this first slide, you see shares of after-tax income over 4 decades. So, for example, in the fourth quintile, median income of $80,000 out of 5 quintiles. So let's look at the middle quintile and the fourth quintile, and then we'll look at the highest quintile. And we're looking at 10-year increments. The 4 bars are 10-year increments. As a matter of fact, share of after-tax income has been fairly flat, although declining just a little bit over the 4 decades, but probably less than one might conclude from listening to some of the people that like to hyperventilate on this subject. And actually, in the highest quintile, you see the share of after-tax income was higher in 2000 for the highest quintile than it was in 2010. And similarly, in the top 1%, that's the case. So actually, we've had a little bit of improvement in the skew of income over the last decade. This is the most recently available data, by the way, through 2010. And this data was published in December of 2013. The next slide is, I think, fascinating because it shows, first of all, what the CBO calculates to be market income. The gray bars are market income, and again, the distribution from lowest to highest quintile. So the way to read this chart is that in the fourth quintile, market income is about $80,000. In the highest quintile, market income is $226,000. So here you definitely see the dramatic skew in income by income bracket. Now, what's interesting, though, is the chart illustrates the redistribution of income that results from 2 things: government transfer programs and our progressive income tax structure. So that if you look at the distribution of income after those 2 things, those income equalizers, so to speak, you're looking at the red bars. And on that basis, you can see that we have, to some degree, mitigated the dramatic skewing in income among income quintiles. Government programs that transfer income from high income brackets to low income brackets, coupled with progressive income tax structure. Now let's talk about the so-called Gini index. The Gini index is one of the most broadly accepted measures of income inequality. And it's really a kind of a fascinating way to compute income inequality, and it does make a lot of sense. So Gini in this chart is A divided by A plus B. So if every household earned the same amount, if every household in the United States earned $50,000, for example, then the cumulative share of people from lowest to highest would run along a 45-degree angle. But that's not the case, of course, and so we actually have cumulative share going on this kind of a curve. The degree of income equality, then, is the area inside this part of the curve compared to the total area of the triangle. I hope you understand that, and if you don't, just take a minute and review this chart and you'll see how it works. Okay, now let's look at the Gini index measures in time series. The first thing to understand, and this is again Congressional Budget Office calculations based on the release December 2013, and it's the most recently available data, and it goes through 2010. Now, step A is to look at market income, and you can see that because the Gini number has been increasing over the last 4 decades on average, we're experiencing rising income inequality, at least measured by the Gini index. Now, however, because of the factors I just mentioned, the redistributive effects of both government transfer programs and the tax code, then the whole Gini measure gets downshifted and you go from A to B, just as a result of government redistribution programs. And so with that step, you have substantially reduced the Gini index, even though it has a positive slope. So we've continued to have increasing income inequality, but the degree of that is substantially less than one would conclude by looking at pre-income redistribution program measure. Now take it one step further and then take into account the tax code, and finally you're at the measure that really matters. Post-government redistribution programs takes you to the red bar. And so on this basis, Gini measures of income inequality are substantially less than the pre-tax, pre-government program data, but you can see that because the slope here has been positive over the decades, we have been experiencing rising income inequality. The red line is the crucial calculation. I was just talking about how the federal tax code, being progressive, does substantially mitigate income inequality. Certainly by no means, all away, but it does have an effect. And so I wanted to show you then in this chart the distribution of both before tax income and federal tax liabilities, which is to say that, for example, the highest quintile earn 52% of total national taxable income, but they pay about 68% of total taxes. The top 1% earn 15% of total taxable income, and they pay about 25% of total taxes. In the lowest quintile, you can see that quintile earns about 5% of total national income and pays no taxes on balance. That is a reference to the progressive nature, and this is a depiction, an illustration of the progressive nature of the U.S. tax code. This report was just issued in September of 2014. It's the Census Bureau's annual Income and Poverty in the United States report. I think more than anything what's happened is because the recession was so severe and so traumatic, as I pointed out yesterday, then it's going to take a long time for the poverty statistics to improve. And you can see that in this recession, the absolute number in poverty surged. And now 5 years into recovery, we're only just working down that aggregate number of those in poverty. What I did find interesting about this most recent survey result, though, is that the poverty rate, this is a function of the population. In other words, the percent of the total U.S. population who are in poverty, actually in this severe recession didn't exceed the peaks that we saw in previous recessions. Interesting. And is way down from, for example, the late 1950s, early 1960s. That statistic has improved dramatically in the last 5 decades, and it didn't exceed the peaks seen in the most recent recessions. And finally, we're seeing a little bit progress of working that figure down post-recession, very much a cyclical phenomenon. These are the mean and median income statistics that you've been hearing about, and the references in the media have been that, for example, the median income at the end of 2013 was the same that it was in 1995. So we've gone nowhere in median, this is the per capita statistic, in the last 20 years. And it's down significantly from the peaks we saw at the peak of irrational exuberance and the subsequent peak in the economy before the most recent recession. The point I made yesterday, too, is that both on the mean income statistic and the median, we are finally seeing some progress. Now, the second aspect of this chart that a lot of pundits talk about, a lot of analysts talk about, is the growing gap between mean and median. And so statistically, what that suggests is you're seeing increased income inequality. And statistically, that would be a true statement. And I showed you that earlier in the Gini statistic. That's why I keep coming back to this chart, which I find absolutely fascinating and actually accounts for the rising income inequality reflected in the Gini statistic, is precisely because the number of households in the 50 to 75,000 annual income bracket has contracted precisely because the number of households in higher income brackets have increased in recent decades. So squashing this curve does result in a higher Gini statistic. And it actually is a phenomenon that looks favorable, looks positive, not negative. We have fewer people in the median income brackets precisely because we have more households than we did in previous decades in the higher income brackets. And by the way, the lines here are 1973, 1993, and 2013, so 20-year increments. And I think it's another way of saying you can't simply take the Gini statistics at face value to really understand what's been transpiring here. Income distribution has actually improved and is corroborated by this professor of economics who wrote this article published in the Wall Street Journal earlier this year. The claim that ordinary Americans are stagnating economically while only the rich are gaining is also incorrect. True enough, membership in the middle class seems to be declining, but this is because more American households are moving up, precisely the point I was just making, and it's based on this set of statistics. Yesterday, one of the questions from the webinar was as follows: should we worry about China and Russia contracting with 8 countries now to buy oil in their own currencies? I don't see why we should worry about that. I think probably the question is directed towards the notion that the U.S. dollar would lose its status as the global reserve currency. That will not and cannot happen probably in any of our lifetimes for the very simple reason that there is such an enormous reservoir of dollar-denominated investments available to investors globally, which is to say that to the extent the Chinese earn U.S. dollars from trading with the U.S. or Europeans for that matter or anybody else, they need to do something with those dollars. And all they can do in the end is find dollar-denominated investments. And what's happened, of course, is that Chinese and others who have earned U.S. dollars have had to and have found it desirable to turn around and invest their U.S. dollars in U.S. Treasury bonds and other U.S. dollar-denominated securities like corporate bonds and even U.S. equities. And that's not about to change anytime soon for the very simple reason that, for example, there is no Eurozone bond. And European debt markets are very shallow compared to U.S. dollar-denominated debt markets. So there is no go-to reservoir that investors have available to them as an option to U.S. dollar-denominated investments. And likewise, China has no government debt market to speak of. There simply is no opportunity to invest in renminbi bonds for those who are earning Chinese currency. So, for example, if the Russians sell China oil and gas and receive renminbi, what are they going to do with them? They can't buy Chinese bonds because they don't exist. They end up having, in the end, to convert to U.S. dollars in many respects and invest in dollar-denominated securities ultimately, one way or the other. So I don't view it as a problem. The next question from yesterday's webinar that I wanted to address in this slide, total employee compensation here is a little over $9 trillion. And how does that compare to the GDP at $16 trillion? Well, the first piece of disposable personal income that I referred to yesterday is employee compensation, which is what you see in this chart. And that constitutes the vast majority of total disposable personal income. So you're at $9 trillion. But then you have to add to employee compensation interest and dividend income, proprietors' income, that's small businesses' income, government transfer payment income, and rental income. So that's the total pie, income pie, if you will, that adds up to total disposable personal income. And so here we see the $9 trillion, employee compensation on the left scale, what you saw in the previous chart, but then on the right scale, interest and dividend income at about $2.1 trillion and so forth. So you add it all up and you get disposable personal income, which is a little over 13 trillion as a percent of the total GDP of about 17 trillion. In other words, since we spend most of our disposable personal income, we save 5.6%, we spend the rest, then personal spending at 12 trillion as a percent of total GDP is about 70. Actually, today it's about 68% of total GDP. Here then is personal consumption expenditures at 68% of GDP. That compares to disposable personal income equal to about 70% of GDP, the 5% differential being savings. And then the rest of the economy is the I, investment, the G, government consumption, and net exports. Here was a question from yesterday's webinar. Even if gas is only 2.4% of household budget, when gas goes up, doesn't that raise the cost of food and beverages because supermarkets have to pay more and raise the prices of their goods and products? Same thing for anything being transported, shipped, including housing materials, construction costs, etc. Yesterday I was talking about the fact that gasoline, diesel, and fuel oil actually are a pretty small percent of the average family budget. So I was saying that a lot of times media commentators, I think, get a little bit too carried away when gasoline prices rise, saying that's going to kill consumer spending. And now the flip side of the coin is because gasoline and diesel have gone down in price, will this be a huge stimulus to the economy? So let's just get the numbers straight. Gasoline, diesel, and fuel oil, 2.4% of GDP, but that compares to food and beverage spending of about 9% and housing spending of about 11%. So again, as a percent of the average family budget, gasoline actually is probably less than what most people might assume. Here I was saying that an 18% decline in gasoline prices could add up to a significant kick to the GDP if these prices persist. 0.43% of GDP specifically is what I'd calculate to be the potential effect on the stimulus to the U.S. economy should gasoline prices remain around $3 a gallon nationally compared to the $3.75 that we found ourselves at recently. Now the question, though, pertains to inflation. Even though gasoline and diesel spending is only 2.4% of GDP, don't those higher costs feed through into the costs of everything that we purchase? And the answer is yes, they do, but to a very modest degree. And that's why I wanted to show you this chart once again. The gray line in this chart is an excellent representation of commodity prices, broadly speaking. There is a significant energy component to the commodity prices represented in the PPI crude materials chart. Even though in the past when you've seen a surge, particularly related to oil prices coming from commodity prices, that transfers on a very muted basis to the overall CPI statistic. And that's the purpose of this slide, to show, to illustrate so clearly how dramatic swings in oil and gasoline prices specifically and commodity prices more broadly only translate into, on a very muted basis, increases or decreases in the headline CPI. So the effect that the questioner is noting is there. In other words, higher gasoline prices would ultimately be included in supermarket pricing and retail prices generally. It transfers on an only very muted basis, and the reason for that is because energy intensity has actually been on the decline as we become more energy efficient in this economy. And so it does feed through ultimately into inflation, but perhaps on a much more muted basis one might expect. Is there any concern about a high percentage of new auto loans being subprime quality? I've read, and here I'm not a real expert, but I have read recently that we are seeing more subprime auto loans as a percent of the total than we were a couple of years ago. So that's definitely happening. But I also read that auto loans actually have a much better delinquency record than even mortgages do. And the point is that people would rather pay their car loan and continue to be able to commute to work than they would pay their home mortgage if push comes to shove. So subprime auto loan quality, in my mind, is not something to be concerned about because the delinquency statistics, even on the subprime sector in auto lending, are actually very strong. Does Fritz use the initially reported or revised GDP percentages in his slides? Well, I use both. In the month immediately following the first release of the quarterly GDP statistic, I use the first reported, but I always go back and revise those slides to reflect the latest reported revision with respect to the GDP statistics. And then the last question we got was this: will the Fed start reducing its balance sheet? QE has stopped, but the Fed still holds a lot of bonds. And the answer, as far as I know, from the Federal Reserve on this question, and I also heard Ben Bernanke, I think, refer to this where I heard him speak at Schwab Impact last week, was as follows: probably the Fed will not sell those bonds that it purchased following the end of QE, but will simply allow those securities to run off, which is another way of saying they'll just let them mature. Think of it like a bond ladder that the Fed has accumulated. They'll just let the ladder run down in maturity. So I think what you can expect is that gradually over time the Fed's balance sheet will contract as the QE purchases simply run off and mature. Okay, thank you very much. I appreciated yesterday's webinar and the questions that came in as a response to that, and I hope this commentary was useful.